Have you ever submitted a credit application only to watch your credit score drop immediately after? It is a frustrating feeling, especially when you are trying to make a responsible financial move like buying a car, getting a mortgage, or opening a credit card. You might wonder why a lender checking your credit score causes it to go down, how much damage a hard inquiry actually does to your Experian score, and how long that negative mark will stay on your report. The fear surrounding hard inquiries leads many people to avoid applying for credit altogether, which can hold them back from securing better interest rates or necessary funding. The truth is that hard inquiries are a natural part of managing credit, but understanding exactly how Experian processes them is essential if you want to protect your score and avoid unnecessary damage. A hard inquiry, often referred to as a hard credit check or a hard pull, occurs when a financial institution reviews your credit report to make a lending decision. This happens when you formally apply for a new credit card, an auto loan, a mortgage, a personal loan, or a student loan. Because you are asking for new credit, the lender wants to evaluate how risky it is to lend you money. To do this, they request access to your credit history from one or more of the major credit bureaus, such as Experian. The moment Experian releases your credit information to that lender, a record of that request is recorded on your credit report as a hard inquiry. It is important to distinguish between a hard inquiry and a soft inquiry. A soft inquiry happens when your credit is checked for reasons not directly tied to a new credit application. Examples include checking your own credit score through a monitoring app, promotional credit card offers you receive in the mail, or routine background checks by prospective employers. Soft inquiries do not affect your Experian score at all, and other lenders cannot even see them when they view your credit file. Hard inquiries, on the other hand, require your consent, are visible to future lenders, and can cause a temporary drop in your credit score. When a hard inquiry lands on your Experian credit report, the immediate concern is how many points you will lose. For most people with a solid credit history, a single hard inquiry causes a minimal drop, typically fewer than 5 points on your FICO score, or 5 to 10 points on a Vantage score. In fact, if you have an established credit profile with a history of on-time payments and low credit utilization, you might not see any point drop at all. Credit scoring models view a single application for credit as a normal financial activity rather than a sign of distress. The real problem arises when you accumulate multiple hard inquiries within a short period across different types of credit. If you apply for 3 different credit cards, a store card, and a personal loan all in the same month, each of those applications triggers a separate hard inquiry. To scoring algorithms and prospective lenders, a sudden cluster of credit applications signals potential financial instability. It suggests that you might be facing cash flow troubles or attempting to take on more debt than you can handle. As a result, multiple scattered hard inquiries compound, causing a cumulative point drop that can noticeably lower your Experian score and make lenders hesitate to approve you. How long does this impact last? A hard inquiry remains on your Experian credit report for up to 2 years from the date it occurred. However, its negative effect on your credit score does not last that long. Scoring models like FICO only factor hard inquiries into your credit score calculations for the first 12 months. After 1 year, the inquiry stops impacting your score entirely, even though it remains visible on your report until the full 2-year mark passes. In many cases, your score will rebound within just a few months as long as you continue to pay your bills on time and keep your credit card balances low. There is a major exception to the rule regarding multiple hard inquiries, known as rate shopping windows. Credit scoring models recognize that when you shop for an auto loan, a mortgage, or a student loan, you want to compare rates from multiple lenders to get the best deal. To avoid penalizing you for smart financial habits, scoring algorithms group multiple inquiries for the same type of installment loan into a single hard inquiry for scoring purposes, provided they occur within a specific time frame. Depending on the specific FICO or Vantage score model being used, this rate shopping window typically ranges from 14 to 45 days. As long as you submit all your mortgage or auto loan applications within that window, your Experian score will only take the minor hit of a single inquiry. Keep in mind that rate shopping logic does not apply to credit cards. Every single credit card application counts as a separate inquiry. To manage hard inquiries effectively on your Experian report, you should follow a few clear steps. First, use pre-qualification tools before submitting formal credit card or loan applications whenever possible. Pre-qualification uses a soft inquiry to check your eligibility, allowing you to see your approval odds without damaging your score. Second, space out your credit card applications by at least 6 months to avoid looking credit-hungry to lenders. Third, keep your rate shopping organized within a tight 2-week window so that multiple loan applications count as one. Finally, review your Experian credit report regularly to ensure all listed inquiries are legitimate. If you spot an unauthorized hard inquiry that you did not give permission for, you have the right to dispute it directly with Experian to have it removed. With that said, thanks for watching, and until next time.